Hello, I'm Andrew Keane from Edison Group. Very pleased to have with us today Purvi Sapre, Fund Manager at SDCL Energy Efficiency Income Trust. SEEIT is a £1.1 billion listed investment trust focused on energy and energy efficiency as a decentralised service. Purvi, welcome. Thank you for joining us today.
Thank you.
My first question is on the issue of energy and energy efficiency as a service. It's a very significant part of the transition to net zero, and it does differentiate you from some of your peers. Can you talk about some of those differences?
Yeah, sure. And I think before we talk about the benefits of energy efficiency, it's really important to differentiate what we mean by that versus what we call our typical renewables. An example I always give that's easy to understand is solar energy and solar projects. A typical renewable energy project will be a large-scale solar project, typically in the middle of a field. We've seen lovely pictures of those. And another one could be the offshore wind farms that you get in the middle of the sea. But if we stick with solar for now, these solar projects typically are connected to the grid. So it's what we call centralised. And they're producing renewable power to decarbonise the centralised grid, replacing traditional coal power plants and gas power plants. The infrastructure asset, the solar project, typically gets revenues from selling to the grid, and these fluctuate typically depending on where power prices are, and we're all familiar with how much volatility there is. But that's typically how revenues are generated. And some of those solar projects have relied on subsidies in the past as well, so you get the benefit of that as well. The purpose of these solar projects, as I mentioned before, is to decarbonise the grid. Why we have energy efficiency is that the grid itself is inefficient. So when we talk about the road to net zero, the analogy I use is that we're going to have to build trillions and trillions of dollars worth of solar, wind, hydro. But you can fill that bucket with all these renewable energy projects, but there's a big hole at the bottom because a lot of the energy that's generated and power that's generated is lost. It's lost in the centralised grid and what we call transmission and distribution losses. It's lost in buildings. We all know about inefficient buildings. So you can fill the bucket, but there's a big hole at the bottom. And that's what we talk about when we talk about energy efficiency. It's plugging that gap. So the investments we make and the projects that we invest in is focusing on reducing that wastage. And an example I'll give that's a direct comparable to the solar project I just mentioned is rooftop solar. Now, how is that different? Well, we brought the rooftop project closer to the point of use, so the person using it, the energy, which is the building itself. So you're eliminating all the losses that you get from the centralized grid. So for the same production, you can utilize more in the building. The second benefit of this is that you're directly decarbonizing the building. So there's no offsetting, there's nothing like that. And that's a typical energy efficiency project. The solar project will typically enter into a long-term contract with the corporate customer that owns the building. So you have good visibility for around 20 years on what your revenues are going to be. And that's the key thing about energy efficiency. It's addressing a number of issues that have come to the forefront. Sustainability has always been a key part of the corporate board agenda. How do you get to net zero without just relying on offsets? Decarbonizing your buildings is key to that. And the second one, particularly over the awful events over the last 12, 18 months, is energy prices. Individuals are looking at it, corporates are. And whereas before, procurement of energy used to sit with the procurement team, it now sits with the CFO and the CEO. So how you reduce your energy costs by minimizing wastage and using less is addressed by our energy efficiency projects.
Can you talk about strategy in general? What kind of assets do you target? At what point in their development stage? How do you think about investment strategy overall?
First thing to know is SEEIT's overall fund strategy, which is to generate a total return for its investors. This is comprised of a stable dividend income and capital preservation, combined with the opportunity for upside opportunity and growth. And that's what we're focused on. In terms of what we invest in, I've mentioned before in a previous answer around the types of investments we make. We typically categorize these into two. The first one is bringing energy closer to the point of use. This is reducing what we call inefficiencies in the grid. The example I gave was rooftop solar. Another great example is LED lighting. You switch normal light bulbs for LED lighting, you can save so much in terms of energy consumption, you can get payback in a couple of years. The second one in terms of addressing energy efficiency is what we call demand reduction. Now this is something that should be familiar to everyone, not just corporates, is buildings and their inefficiencies. We've heard a lot of people talking about insulation and double glazing. They're all critically important because it's these sort of measures that reduce energy consumption. So in terms of SEEIT strategy, our investments have to fit into those buckets. The second thing that we also look at is across the majority of our investments, and more importantly our larger investments, is the opportunity for growth. So whilst the example I keep going back to is a solar project, you have long-term contracts, visible cash flows. That helps with the stability of capital preservation as well as dividend income. The other thing that we focus on is with all those investments, is there an opportunity for further increasing those cash flows? Now that could be done in a variety of ways. Some of it's increasing revenues. You're connected to an end user. They might not just want solar, they might want other services. We can enhance the revenues. And the other one is reducing our operating costs. And so with most investments we look at, SDCL as the manager is adopting what we call an active asset management strategy, which is we don't just buy the assets and wait for the cash flows to come in. We are actively pursuing, implementing and investing in growth opportunities that further improve the value of those projects and enhance returns to investors.
In terms of geography, around 60% of your assets are currently based in the US. Is that an issue driven by opportunity or driven by policy environment? What drives those geographic decisions?
It's part of policy and opportunity. We've focused very much on diversification, both in terms of technology, in terms of counterparty exposure, as well as geography. Now we do have a leaning towards the US at the moment, and this is a reflection of a number of things, particularly the fact that the US has been at the forefront of energy efficiency, not just because of sustainability, but what I talked about before, which is around cost reduction. And so the US is a lot more advanced than some of the other geographies, and therefore in terms of opportunities to acquire projects and make investments, it was a bigger market to start with. We also see the fact that there is a huge tailwind in terms of policy there. Now, people may or may not be familiar with the Inflation Reduction Act. It's a policy that's been implemented in the US, and it's a huge opportunity for a lot of capital from the government to come in and support renewable energy and energy efficient projects across the US. How does that impact us? It means that the projects that we invest in are more attractive, generate better returns than they probably would have done 5 years ago. So we see a huge opportunity in the US for that to happen, and it's a huge market. Having said that, that's not to say that Europe and UK aren't attractive markets. They are getting there. We've already seen, and we have seen over the last few years, both in Europe and in the UK, but Europe in particular, energy efficiency being one of the top priorities. The key thing that we have to ensure that happens and governments do is that policy is implemented effectively across all geographies. And we expect that to happen, and we're seeing more momentum now. Again, because of the issues of the last few years, particularly around volatility in energy markets, cost reduction is key, not just to governments, but to corporates. And yes, in the UK, there have been some disappointments in terms of energy policy, rolling back on what was announced. But this is the thing to remember about energy efficiency. It's not reliant on subsidies. You don't need a subsidy to understand or to benefit from having LED lights, for example. It pays for itself within 1 to 3 years. And that's what we really want to make clear, and what sets us from potentially a number of other renewable energy sectors, is that this all pays for itself. It doesn't need government intervention. It helps, and it'll support the growth of the market, but the investment case stands on its own 2 feet. And that's why corporates and individuals and businesses are all adopting these policies now.
Can you talk to the issue of NAV accretion from potential management gains from within the portfolio? I know that you've increased your disclosure and talked about KPIs within assets. Can you talk about what that brings to fund performance over time?
Yeah, so I'm glad you pointed it out, and it's been recognised that we have made a lot of effort to improve our disclosures, and particularly in our annual results. And this was taken by feedback from investors as well as analysts. The reason we wanted to do that is that we wanted investors to understand how our assets operate and to be able to track their progress. And that's what we hope that can be done over the next few periods, is that you can see how our investments are progressing against what their expectations are. NAV growth is something that we've talked about and we've disclosed in our annual reports, the upside opportunities that are not in the NAV today. The part of the investment strategy has been that we make investments where we can deliver that, where it's identified before we've even invested. It's what makes up our investment strategy. And some of our largest assets have strong growth stories associated with them. We do have an active asset management strategy, not just at the manager level at SDCL, but we have people on the ground. We have over 200 people across our portfolio that are dedicated to working and optimizing the investments, be that in the US, in Europe, and in the UK as well. And there are a number of opportunities that will be crystallized over the coming years. Some of these take time to deliver. And again, as part of our disclosures, we've identified where those are in some of our larger assets and how long they could take to crystallize. And some of the examples I wanted to give were in the US and in the UK. So our largest investment is called Red Rochester. And to keep it simple, it is the energy plant that's providing on-site heat, power, electricity, and over 13 other utility services to a business park in Northeast US. The customers, and there's over 100 of them, are commercial and industrial customers, food and beverage, data warehouses, amongst other things, and manufacturing. They all have high energy uses, and we're providing that. We are the exclusive provider of that. So it's a large investment, multi-services, multi-customers, and it's one that we're very proud of. Now, we could just acquire that asset. It's income generating, it delivers long-term visible cash flows, but that's not what we're doing. There are two main opportunities to deliver further growth in Red Rochester. The first, as you'd find with any utility, is that we need to help attract more customers to come in to the park. It's underutilized, the park, so the more customers that come on, the more revenues that can be generated from fixed charges. That's all of a benefit and an upside to Red Rochester. The other one, and this is really, really interesting and exciting, is if we improve the efficiency of the operations of Red Rochester, the cost savings are directly benefiting Red Rochester and therefore SEEIT. So if you reduce the running costs of providing heat, those savings come directly to Red Rochester, and that's one of the reasons we're investing in a new cogeneration plant to replace old efficient boilers. We're replacing the chillers, amongst other things. So there's a lot of investment, a lot of time that's being spent by SDCL and the employees on the ground to improve the efficiency. So that's a great example. There's a whole list of projects and more coming as we keep implementing those at Red Rochester. Another example here in the UK, and people might be familiar with, is EV charging. So we are an investor in a developer called the EV Network, and we fund and we own and we operate the EV charging infrastructure that's being placed across the UK. One of the largest ones being the NEC car park in Birmingham, which is one of the largest fast charging EV hubs in Europe. We were there to funding the first EV charging hub, and we're here now today funding 180 at the NEC car park. This is where value comes in. It's not just funding the infrastructure, but we're building value within the business and the developer. And that's something that SEEIT shareholders will benefit from as well. Long-term contracted cash flows that you can get from the EV charging, as well as other value creation from creating such an attractive platform.
I want to ask about the issue on discounts. Now, it's something that's affecting firms right across the sector at the moment. Can you talk to the issue of how you're trading at a discount to NAV, how that relates to discount rates, and what you think the outlook for that is overall?
So in terms of discount rates, it's something that we have been acutely aware of and have seen the impact of, be it in the rising debt costs or in how discount rates are used in valuations, and where you're seeing M&A processes and where valuations have gone, not just in the UK, but also in Europe and in North America as well. Our response to this has been that we have moved our discount rates to reflect the reality of where interest rates are. We do take independent advice with our valuation on the full year, and we've given more information on that in our annual results. But that is something that has been acknowledged. It's also acknowledged in terms of where we are targeting returns for investments today. We've talked about organic opportunities and investing in existing portfolio. There's a reason why we're doing that, is that the returns are a lot more attractive than what you're seeing in buying new investments. Because we're developing those projects, we own them, you can get much more attractive returns than you would do in third-party investments. And that's why we're focusing on making investments in the existing portfolio where you can get much, much higher returns. And again, that's reflective of where the higher returns environment and the higher rate environment and what we need to get.
The other thing that presents an opportunity for investors, I guess, is dividend yield. You're trading at an over an 8% dividend yield at the moment. Can you talk to the issue of dividend coverage and what your dividend progression policy is as well?
So SEEIT has always pursued a progressive dividend policy since listing, increasing its dividend per share year on year from 5 pence at the time of listing to 6.24 pence where it is today. Investment cash flows are up 32%, providing a healthy cash cover of 1.2 times, which is in line with expectations. This is supported by a strong liquidity position, low gearing, and healthy cash cover, which supports the progressive dividend policy.
So just in summary, from an investor's viewpoint, what is the opportunity here? Is it to invest for environmental benefits, or is it to invest for returns?
I would say it's all of those. I mentioned before around the sustainability and the need for energy efficiency and supporting our ability to get to net zero. It's a critical path. It goes hand in hand with renewables. So it's a strong sustainability agenda, and it needs to be progressed. See, it's one of the first investment trusts of its kind in terms of focusing on energy efficiency. It's a huge opportunity, not just for SEEIT, but anyone who's looking to get into energy efficiency, be it in North America or in Europe. So again, attractive investment opportunities for growth. Again, the investment strategy is not just about capital preservation and dividend income, which is a key priority for us, but it's also about total return. Our largest investments are what we call active investments. It's not just relying on the existing cash flows. It's rolling our sleeves up, identifying growth opportunities and implementing and investing. We've identified and we've shared with investors where we see growth opportunities over the next 3 to 5 years. So I think combined the two of those, total return as well as sustainability, are really attractive opportunities for investors coming in to see it.
Purvi, thank you for joining us today.
Thank you.
For any further information, please visit Edison's website and refer to our recent initiation. Thank you for joining us today.